Expectations for an interest rate cut by the U.S. Federal Reserve have cooled quickly. The market is cautiously raising the possibility of raising interest rates again. When examining the direction of the U.S. Federal Reserve's monetary policy, the first thing to look at is the price index. However, the main focus of market participants is on the outlook for U.S. economic growth this year. The price index did not deviate significantly from the path the Fed expected. On the other hand, the growth path of the U.S. economy is significantly deviating from the Federal Reserve's forecast. More weight will be given to indicators that deviate significantly from the projected path rather than indicators that did not deviate significantly from the projected path. Growth rate that exceed expectations increase inflationary pressures in the future. While the solid economic situation in the United States continues, it is entirely possible for the U.S. Federal Reserve to raise interest rates again if inflationary pressures intensify due to the geopolitical crisis in the Middle East. Until the beginning of the year, the market predicted that the Federal Reserve would cut interest rates 6 times this year. However, U.S. economic indicators were released one after another, at a level exceeding expectations, suggesting that the strong economy is continuing. As the price index was also announced at the surprise level that exceeded expectations. Expectations of an interest rate cut gradually receded. Recently, as geopolitical risks in the Middle East surrounding Iran and Israel have heightened, international oil prices have soared and inflation has been predicted to accelerate again, depending on uncertainty about the Federal Reserve's monetary policy. The financial market has begun to consider the possibility of the Federal Reserve's raising its benchmark interest rates. As the aftermath of Federal Reserve's Chairman Jerome Powell's remarks hinted that the interest rate cut would take longer than initially expected. Similar remarks from Federal Reserve's members followed. In addition, the rise in government bond yields continued due to the favorable employment and manufacturing indicators announced on the day. In particular, with the observation that it would be difficult for the Federal Reserve to cut interest rates this year, even the interest rate hike theory has raised its head. On April 18th local time, John Williams, president of the Federal Reserve Bank of New York, made a statement leaving open the possibility on interest rate hike. He mentioned that although it does not seem likely that the Federal Reserve will resume raising interest rates, it may raise interest rates if inflation rebounds again. Atlanta Governor Raphael Bostic also expressed the view that there will be no rush to cut interest rates and that there is no time to cut interest rates until the end of the year. Federal Reserve Chairman Jerome Powell, who had repeatedly emphasized that He expected an interest rate cut within the year, also changed his attitude. He implied that the high interest rate situation could be prolonged. Speaking at the Canadian Policy Forum in Washington on April 16th, he said the latest data clearly does not provide great confidence that inflation is reaching 2%, and suggests that it will take longer than expected to get that confidence. Experts believe that it is unlikely that the Federal Reserve will actually raise interest rates further, but analyze that it is possible. In particular, experts note that in the April revised forecast released by the International Monetary Fund, this year's U.S. economic growth rate was revised upward from 2.1% in January to 2.7% in 3 months. Forecasts have begun to suggest that the U.S. economic growth rate this year will be higher than last year's 2.5%. In particular, at the Federal Open Market Committee (FOMC) in March, the Federal Reserve's economic growth forecast was revised upward by 0.7 percentage points from 1.4% in December 2023 to 2.1% in March. The reason the Federal Reserve's forecast for the U.S. economic growth rate exceeds 2% is because it exceeds the U.S. potential growth rate 1.7 to 2.0%, and is a region where an inflation gap occurs. Looking at past trends, interest rates cut are made in the inflation gap section. But they begin in the later half of the year, and the section where the interest rates cut actually begin in earnest is not in the inflation gap section, but in the deflation gap section, where the actual growth rate is lower than the potential growth rate. It comes true. If the U.S. economic growth rate exceeds 2% this year, an interest rate cut may begin, but it is highly likely that the full-scale interest rate cut expected by market participants will be postponed until next year when it turns into deflation gap. If the economic growth rate is higher this year than last year, we may face a situation where interest rates have to be raised again, let alone lowered. Recently, geopolitical risks in the Middle East have increased, which could lead to an upward trend in oil and commodity prices, leading to a prolonged period of high interest rates. There is a risk that tensions will rise further in the Middle East. As a result, we may face higher oil and commodity prices for longer. This will put us in environment of higher inflation and will be an environment of higher interest rates. However, most opinions are that the possibility of the Federal Reserve actually raising interest rates is limited, considering that the disinflationary path of product prices is in effect. It is premature to reflect the possibility of interest rate hikes again at this point, and future price indicators need to be confirmed. Currently, the market is reflecting the possibility of one interest rate cut within the year, with the first interest rate cut starting in September. There is no need to consider the possibility of one increase, while the interest rate cut outlook is still valid. As expectations of the Federal Reserve's interest rate cut recede, the yield on 2-year U.S. Treasury bonds is soaring, touching 5% at one point. This could lead to a rise in U.S. mortgage interest rates. Ultimately, higher interest rates could increase borrowing costs across the economy, potentially having a negative impact on consumer spending, business investment, and the housing market. However, some say that even if interest rates are not lowered within the year, cracks will not occur, as the U.S. economy is already in a solid state. The economy is already strong enough that there is no need to cut interest rates to avoid a recession.